Welcome to The Man from Macro, and this week we're going to be looking at the US, but in context of what's happening in the rest of the world, because recently there's been a lot of focus on the US slowing down, and therefore if the US is slowing down, US assets starting to underperform. But obviously in the world of investing, it's global and everything is interconnected, so it's actually some of the relative performance that really matters. So first, let's just have a look at a couple of things that people are staring at in terms of the US. And I think it really starts with the deterioration that we're starting to see in the employment market. Now, it is very marginal. We have just seen a new high, new recent high in terms of the unemployment rate at 3.8%. But it's only just broken out of this sort of 12 to 15 month band of around about 3.5%. And a lot of this increase is actually due to people coming back into the labour force. But nonetheless, we've seen the JOLTS job openings starting to decline much more rapidly, and we're seeing those downgrades to non-farm payrolls. So the last 12 months, we've seen the actual numbers being reduced, i.e. they weren't as impressive as originally thought. But what I'm also going to do is use a few charts which I've been looking at on Twitter from other people, which also show some of these deteriorations that are happening in the fabric of the US economy. And the first one I'm looking at here is bankruptcy filings. What we can see here is that the 4-week moving average of US bankruptcy filings has been shooting up to levels that we saw in COVID and not that far away from what we saw in 2007, 2008. And yet it feels like this should be something which is slower burning and taking a little bit more time to ferment. So there should be a lot more to go here compared to what we saw during that COVID period. The second one we're looking at is from Kubasi Letter. These are all on Twitter if you want to look for them there. And this is the delinquency rate on credit card loans at small banks. These are the banks outside the top 100. And what we can see here is that these credit card default rates are now at the highest level that we've seen in about 20 years. So higher than during COVID and higher than during the great financial crisis. And these banks are being hit from a lot of different angles. Remember, these are the banks that have been seeing this huge avalanche of their cash, basically their balance sheets, moving away into money market funds as people flee these banks. It's been more of a walk or a jog than a bank run, but it's been going on over the last few months. These banks are also exposed to the commercial real estate sector as well. And also their assets were obviously impaired by those high yields and falling bond prices. And remember, yields are still close to their highs and could break up and those bond prices fall even further. So these small banks are being hit from all angles. But this is showing a deterioration in some of the fabric, but these are very slow moving effects. For instance, we are seeing credit card delinquencies, but that's probably within maybe the lower income part of the market. The higher income part still have some savings, but many people feel that those savings will start to run out in the next couple of months. But that cohort would still then need to go into using credit rather than using savings, and that could take a few months to come through. And this is the issue that we have when we think about the US and people focus purely on the US and US deterioration. Yes, there are signs of deterioration, but is it happening at a faster or a slower pace than other regions of the world? And in many cases, it's happening at a slower pace. First, I'm going to look at Europe, and here we can see a chart. This is showing the Eurozone's bank lending to households. And here we can see a dramatic collapse, much faster, or at least not as fast, but certainly deeper than we saw during the COVID crisis, and certainly actually worse than we saw in both the debt crisis of 2011-12 and even the great financial crisis of 2008. And this is a broad-based European metric. I think within Europe, we are seeing a sort of two-speed economy. Some of those oldies but goldies that were hit very badly during the debt crisis, places like Spain and Italy, maybe are not on the front line this time. In some ways, the tables have been turned, and the place where people are now looking is Germany. And here we can see some charts which show that Germany is having some problems. That powerhouse has started to come unstuck. The first chart we're looking at about Germany is from Dario Perkins, and this is orders within the German auto industry, and they are collapsing. Now, not as much as they saw during COVID or the debt crisis or the great financial crisis, but this does feel like an early stage story because there's now so much competition in the new versions of cars, electric cars, etc., from places like China that this could be a major headwind for that massive part of the German economy. We've also seen German factory orders starting to decline as well. They're at the lowest level since COVID. So this whole manufacturing powerhouse, Germany, is now starting to see a lot of weakness. And although Germany is not the totality of Europe, Europe is an exporting bloc. And other countries are probably going to be suffering some of the issues that are facing Germany. But Germany was so concentrated in that exporting, particularly to emerging markets, we are now seeing some problems starting to foment in Germany, and they're coming very much through the front windscreen, as it were. Now, one of the other regions that we've talked about before is China. And China is certainly starting to show signs of a slowdown, and that's also impacting emerging markets. We've shown this chart before. This is the renminbi, this is dollar versus the renminbi. And as you can see, the chart going up is dollar strength. So dollar has been strengthening versus the renminbi. In fact, we've just broken to a multi-year high. Now, every time we see these moves starting to break out, we do see a policy response. And on Monday of this week, we did see an intraday move in the renminbi strengthening. So this is the line falling here, and you can see quite clearly on this chart. Now, this is the dilemma for policymakers within China, is that they do want to see the renminbi weaken, but they don't want to see it weaken dramatically. As with everything, if things move gently in one direction or the other, people can adjust. If they move dramatically, we can have shocks to the system. So they will try and manage this. And one way that they've been talking about managing this, and they have been doing, is selling US treasuries. Their holdings have been falling for 5 years. They sell dollars to buy their domestic currency, often not just to push it higher, sometimes just to smooth out the decline. We should expect the renminbi to fall further because there are big problems within the Chinese economy, which we've talked about before. And we can see this when we look at this chart of the Hang Seng, which is the Hong Kong market for property index, which has a lot of these Chinese companies in it. Now, despite massive policy intervention over the last couple of weeks, both monetary and macroprudential, we've only had a small uptick in this property index, which suggests that there is a little bit of a worn out market here. Yes, we're seeing supportive measures, but these are supporting a decline. It's like a slowly deflating balloon because they want to prevent an implosion. So policymakers here are putting these policies in place to try and slow down what is probably going to be a long-term deflating effect within that market. And we've seen this spreading to other regions because where China goes, other emerging markets go. We talked about the dollar before. And yes, the dollar looks a little bit like it's breaking out versus the euro, but it's still relatively weak versus where it has been. But versus emerging markets, as we can see on this chart, this is the JP Morgan Emerging Market Index. The emerging market FX index versus the dollar is on its lows. That's dollar strength. These are close to those all-time lows. So the dollar has been strong. Emerging markets have been weak. And this then comes into the problem, which we talked about the US being slow, but how fast is that slowdown versus Germany, versus China, and even Japan? Because Japan also has a problem, because Japan is seeing inflation which is stickier than they used to, with bond yields which are far below those inflationary levels. And they're trying to manage those yields higher so they can start converging on the inflation levels. But that is a difficult process for them because it involves quite a lot of intervention in the market still. Although they will let those yields go higher, they will want to manage that. And again, that probably means that they're going to be having to buy bonds throughout, which could keep the yen on the back foot. And that's going to be a problem for domestic inflation. So it becomes a little bit of a vicious circle. And then, as I say, when we look at the US, it's not all that bad. When you look at the services sector, that's surprised on the upside. This is the ISM services sector, which is about 70% plus of the economy. We always look at the manufacturing because that has the highest delta. We get more information more rapidly from manufacturing, but that's only about 10 to 12% of the economy. Services are doing well into expansion territory. This is not the sort of level where we can say we are in recession. Now, a lot of people say, well, maybe we are. What we've seen in the US is we've seen pockets of recession in certain geographies, so certain regions and certain businesses. But we've not seen these all converge into a countrywide, business-wide recession like we saw in 2008 or, let's say, in COVID, but that was obviously an exogenous shock. So some parts of the US economy are doing relatively well. And furthermore, as we've discussed, there could be some stickiness to CPI. CPI has been dropping, but last week we showed the picture of crude oil versus CPI. These two have ebbed and flowed together over the last few years. When oil prices go higher, CPI tends to follow. Well, oil prices have been going higher. It looks like WTI could be testing that $90 level. Some people think it breaks 100 again. There are some imbalances in this market. And therefore, CPI in the short term, year on year, could follow oil. And we could see CPI base at a higher level than the Fed wants. We could even see a few months where we see CPI going up again. So this is the problem because, yes, we are looking for a recession, but how quickly will it come? But also we're looking for a policy response, or at least a policy U-turn. And how quickly will that come? Well, we might not get a recession as quickly as some people would like, and we might not get a policy U-turn as quickly as we'd like if we're seeing sticky elements within the inflation spectrum. So overall, we are seeing the US looking like it could be quite resilient at a time when other regions are doing poorly. So on a relative basis, the US might actually be one of the strongest places in the shop, as it were. So what are the ways that we might be able to play this? Now, remember, these are merely observations. This is not trading advice. This is purely for engagement purposes. But I'm going to look at 3 ways that some people are, in fact, looking at how to play these sorts of scenarios. Now, the first one is the DAX, which is the German equity index. And currently the DAX is riding high. It's near the all-time highs. It is starting to roll over, and it is a little bit of a consensus in the short term that it should roll over, according to the Bank of America survey. But over the long term, the Bank of America survey expects the DAX to go higher over 12 months' time. Now, the thing about the DAX is when it does roll over, it rolls over quite dramatically. In fact, the biggest pullbacks over the last 23 years have been anywhere between 25 and 72%. So this is a big mover when it happens. So you might want to think about buying puts on the DAX. The only problem with that is that those puts are relatively expensive versus what the market is doing. If I look at something like a December 95% put, so around about the 15,000 strike, they're currently around about 16.75, maybe 17 volatility, whilst the market's realizing around 7 to 12. So yes, this partly is in the price already, but you do get bang for your buck when this market rolls over. So certainly that's one thing to look at. Another one we've talked about before is the energy sector. Now I'm going to look at the European energy sector, the SXEP Stock 600 versus the Stock 600 market itself. When we look at this index versus recessions, global recessions, using the US as our global proxy, you can see that 3 of the last 4 recessions has seen the SXEP, the energy sector, outperform the broad market. The only one that didn't work was COVID, and that's because everything got shut down. So you may want to think about moving some of your positions into some of these energy stocks because they tend to perform okay, because in a common or garden recession, we don't pull back too much on the general driving around and activities that we do. Business continues at a slightly slower pace, but not a much slower pace, versus everything else, which often can fall quite dramatically. So SXEP and even XLE versus the broad market may be a way to play it. And then the third one, and by the way, if you're liking what you're hearing, please do ring the bell and press that subscription button so that you get all the alerts and the Man from Macro pieces as they come out. But that third bit is the dollar index itself. And the dollar index is, as you recall, 57% euro. There's a little bit of sterling in there, but a yen, but a Swiss and a few others. But it's mainly the euro. And this has been breaking out, but it's still way off the highs that we've seen. So this is dollar breaking up. Now, this might be a decent hedge, being long the dollar or long dollar calls or long euro puts, playing the downside. Because remember, the DAX puts, they're relatively expensive. When we look at the equivalents on the dollar, and when I'm looking at these, I'm thinking about how expensive are they versus history. Well, yes, the dollar upside and those euro downside, euro puts, are slightly expensive, but not dramatically so. So you might want to think about buying some calls on the dollar. Now, this is not to say I'm a dollar bull and I believe that tribal story, dollar going up. This is to say, okay, this might be a story in the short term that we get a global recession and it's led by places like Germany and China first, and therefore the dollar outperforms in the short term. And I want some of that positioning on. Now, also remember, you've got to vol adjust these things. When we see these moves in the dollar, they tend to be much smaller, much shallower moves than we see in the DAX. Volatility in the dollar is much lower than volatility on the DAX. You have to reflect that. So you have to have bigger positions. So you might want to check the position that you want and adjust it to reflect that. But the dollar itself could be a good hedge to a global equity portfolio or a European equity portfolio, simply because that might be the big mover if we get the slowdown first. So that's what it's all about, really. We're looking at the US slowing down, but we can't look at it in isolation. We have to look at it on a global basis. And it looks at the moment like Germany, the powerhouse of Europe, is anything but a powerhouse. And Asia, China, Japan particularly, are all starting to show signs of problems or weakness that could happen much sooner than we see the deterioration in the US. So the US could have a bit more longevity before we see a true recession there or a big policy U-turn.